This week, we welcome Chase Robertson, CEO at Robertson Wealth Management, to discuss the current state of the financial markets. In our second segment, we'll review the Security Weekly 25 Index and all the financial updates for both the public and private security markets. Business Security Weekly starts now.
This is Security Weekly, for security professionals, by security professionals. Broadcasting live from G-Unit Studios in Rhode Island, it's the show where we explore the business of security to improve the security of business. Your trusted source for actionable insights on leadership, communication, and innovation. Get ready for Business Security Weekly. Do you know what the biggest cyber risk is for your organization? It's the browser, and your users are in it all the time. Every time a link is clicked, untrusted web code enters your network and runs on your machine, exposing you to risk. What if users had full access to the web but never touched web code? You'd have all the benefit of the web and none of the risk. That's why Authenticate built Silo. It's a browser built in the cloud that runs all web content in a remote, isolated browser that never touches your network or device. With a simple click, your organization is fully protected from all web exploits. Find out more at securityweekly.com/authenticate. That's authentic number 8.
Welcome to Business Security Weekly. This is episode number 159, recorded January 20th, 2020. It's Martin Luther King Day and our quarterly Security Money Show, but that means we're also missing Paul. I am your host, Matt Alderman, here in Colorado, joined by my co-host, Mr. Jason Albuquerque, also remote today.
Happy Monday, Matt.
Happy Monday. Well, we did get some interesting football games, the national championship since the last time we met. Great game. Loved the outcome of that game. And, yesterday's games on the pro side were definitely interesting. I was rooting for the Titans, though. I wanted to see if they could knock off the Chiefs.
Yeah, I was rooting for the Titans as well. The definitely want to support the Patriots, the expatriates that are on these teams. So I'm going Jimmy G in the Super Bowl.
There you go. Yeah, you have to. And look, when I saw Garoppolo in preseason against my Broncos, I was like, oh my God, this is going to be a horrible season. Here they are in the Super Bowl. It's been an amazing season to watch them.
Absolutely. Yep. Good luck to them.
Yes. Okay, it's time to attend RSA Conference 2020, February 24th to the 28th, and join thousands of security professionals, forward-thinking innovators, and solution providers for 5 days of actionable learning, inspiring conversation, and breakthrough ideas. If you register before January 24th, that's this Friday, you save $900 on a full conference pass. You can also save an extra $150 with our discount code. Visit securityweekly.com/RSAC 2020 to register. We will also be recording in Broadcast Alley at RSA Conference. So please visit that same landing page, securityweekly.com/RSAC 2020 to book your micro interview or sponsor one of our enterprise shows, which will be recording from the conference. All right, let's get into our guest introduction. Chase Robertson has over 12 years of experience in investments, private equity, investment banking, and corporate banking. Prior to assuming the CEO position at Robertson Wealth Management, Chase served as managing director of Robertson Global Credit and a principal and co-head of energy at Industrial Capital, whose clients include Texas Teacher Retirement System, the City of Chicago, the state of Vermont, sovereign governments, and other families globally. Prior to Industry Capital, Chase was a senior officer at Iberia Bank, which is a publicly traded Louisiana-based bank. Chase, welcome to Business Security Weekly.
Thanks, Matt. Thanks for having me today.
So I need to start with the story of how we met. Some people have heard parts of the story, but not your part.
Sure.
Last year, my son decided he wanted to attend high school at the Air Force Academy. There's a public high school at the Air Force Academy. And I used to have to drive him a half an hour down to the Air Force Academy, drop him off, and then drive home. And it just happened to be during the radio show. So Chase has a radio show called Straight Talk Money. And it just happened to be part of that commute. And I just listened to you and Peggy. And I'm like, I've got to meet you. I want to learn more about what you guys do at Robertson Wealth Management. And that's why I reached out to you way back in the day. So give people a little background, because your background's very interesting, but this radio show thing is also kind of fun too.
Yeah, so I spent the majority of my career working on Wall Street. And then, an unusual opportunity was presented to me at the end of 2016. My late father, the founder of Robertson Wealth Management, founded in 1976, passed away. Either way, I had to move back to Houston to take care of my father's affairs. But part of that was assuming control of a company that this had been our succession plan for a long time. It was just a little bit earlier than expected. So, me and my family moved from San Francisco, where I was head of Industry Capital's energy group, took over Robertson Wealth Management, which is one of the first family offices found in the late 70s. Fast forward till now, we manage money for about 3,500 families globally. And one of the things that really sets us apart is that, the majority of our strategies are proprietary, meaning my CFAs, my PhDs, including me, our investment committee pick the stocks. It's not a one-shop stop where you just get thrown into BlackRock or Blackstone's, ETFs. Not that that's a bad way to do it, but this is a little bit more customized. And then another thing that really sets us apart, or I think makes us a little bit different, is we have the radio show. Initially a TV show back in the day, fast forward till about 8 years ago, turned into radio, nationally syndicated, about 1.3 million daily listeners. So our new market's Portland. But oddly enough, and it's yielded some phenomenal relationships with the firm, Denver is our booming market. That's where we're getting not only the best new clients, but just a flood of people that are looking for the family office services, the investment management services, and the financial advisory to either get to the retirement or have the cash flow in their retirement that they need to pay their bills. So,
and I'm curious, is that because we've seen a lot of influx into Colorado from the oil and gas side, right? We've seen a lot of people from Texas with the oil and gas here and the shale oil come in. Is it because of that and people kind of know the Robertson name, or is it people outside of oil and gas too? I'm just curious.
I think that's actually a really good question. So I think in the oil world, we're a well-known financial advisor because we not only advise individual, but we advise companies on drilling and analysis, financial analysis. We're a financial advisor to oil companies also. Energy is a big space of ours. So I think that's part of it. I also think, just analyzing this thought process, we have a great person on before us and after us in Denver. And it's the right time. It's also the most listened to conservative station. And I think that kind of formula leads to, getting us to about half our listener base. Now, I say that the last time I was in Denver doing prospect meetings, the average person drove over 4 hours to come meet with us. I don't know if that's, just how spread out Denver's grown and boomed. But, we're talking as far as Cheyenne, Wyoming, Estes Park, Colorado. I mean, the station really reaches far there. But for years we drove in business from New York City, San Francisco, California, New Orleans. And now it's, Denver, New Orleans, and Houston are kind of leading the pack. So, it's great because those are places where people have great personalities. Financial advisory is a relationship. It's a long-term relationship, and having great clients that that like your investment strategies and like what you do for them, makes my job and our job here that much more enjoyable. So it's been a great fit for us, and the state of Colorado has been real good to us Texas boys down here.
Yeah, we like when you come in here. We always have fun seeing you. So give the audience kind of an overview of the market. We've seen the market go on an interesting tear over the past few weeks, right? We resolved some issues with China from a trade perspective. We're really seeing the markets click up here. Kind of give us an overview of what's going on in the market and kind of what's driving this market. And then we'll talk about, what slows it down, and then we can talk some submarkets.
Absolutely. So, the key thing, when you look at the market is, and Matt made a good point, you need to know what takes it up and you need to know what takes it down. You're going to be a good investor. And I like to break that into 5 points. So that's valuation, momentum, fundamental, psychology, and liquidity. I think right now, psychology is leading the pack. people want to be in the market. A popular phrase from this generation, I technically fit into it, but I do not believe I am a millennial. I think I'm right on the year, is FOMO, fear of missing out. I use the term FWAM. We made that up here, fun without me. But at the end of the day, people want to be in the market right now. And it's a good place to be. It's done phenomenally. There's great liquidity in the market. There's great momentum. Earnings are slowing. Stocks are expensive. There are some value to be found. We run ultra value portfolios here that we buy things on sale. But one thing I note on the show on a regular basis, Matt, when we look at valuation, I have clients that won't overpay for a bottle of water, but right now they want to overpay for stocks, and that usually leads to some problems when people will just blindly put their capital to work with no appreciation for the real risks on the table, the concentration in their portfolios, and how it fits into their balance sheet. Equity exposure is one thing, but overpaying historically does not lead to the investment returns that you want. We are institutional investors that focus. We're almost crazy about not overpaying for stocks. We want it. It doesn't matter if it's the greatest trend ever. We refuse to overpay from a valuation standpoint, and that's kept us out of a lot of trouble. As you make your money on the buy, you don't make your money on the sell. So we're looking at valuation, tremendous momentum from people thinking that they're going to miss out. Fundamentals are good. When we look at valuation from a price earnings standpoint, I immediately go to cheap money, where the Fed has kept the interest rates. If they stay where they are, the valuations, let's just use the Dow 30 stocks, are very appropriate. If interest rates bounce upwards, those valuations aren't going to hold. But for now, they're within a good range. We touched on psychology, and then momentum and liquidity are kind of the same thing. Just there is a ton of liquidity. I like to use Boeing as an example. For every buyer, Boeing has a ton of headline risk. They have $20 billion in liquidity. They tapped half of it today. But at the end of the day, from every buyer, there is a seller of Boeing stock, and that's why you haven't seen it pull back the way it's been expected. Mm-hmm. So those are just some examples. But those are the 5 points that are driving the market. We expect the market to climb 6 to 12% this next year. We expect earnings to deteriorate between 5 and 10%. Bottom line, just from the economy slowing. Impacts of the trade resolution, even though the tariffs haven't come out, we still see that. And then the impact of commodity prices and other cyclical and geopolitical events, we think will erode earnings just a little bit.
So Chase, if you could just follow up on one of the things you had mentioned about kind of that knee-jerk reaction to buy, right? Is it because we're in this healthy labor market where, retail sales are strong, housing market's strong? Is it just that simple fear of I don't want to miss out? Is that why you're seeing that knee-jerk reaction?
We think so. Whenever we write an investment thesis, myself and my investment team, it's usually 100 to 150 page document on why we're buying a stock, why we want to sit on it. And a lot of those stocks that we bought 3, 4, 5 years ago, and somebody asked me this past week, and just gives you an idea. My oldest position dates back to the 70s. So in some of our ultra long portfolios, that's how long of an investor we are. But as we look at people just wanting to get in, and the way we approach our investment thesis, we buy at the right price, we watch it materialize, and then at a certain point, if we've collected the upside and the dividends that we expected, if let's say you had 200 shares of stock in your account, we might sell 100 and curve them back. But we absolutely are not going to go back in, if we're back to kind of your question, and just buy more and more and more because we think this is going to go on forever. Between all of us, the oldest partner, Robertson Wealth Management, just turned 75. I'm 36. Between all of us, it's over 300 years of investment experience, probably significantly more than that. It's very important to recognize that people are just buying for no reason. Let's talk about two stocks that overlap what you guys like to talk about. Apple. Apple has historically been cheap. It's Buffett's number one pick, but it's had a great run. It's one of the most shorted stocks in the FANG group right now. Last 90 days, it's practically doubled. Tesla's doubled in the last 90 days. Most shorted stock on earth. So I think the other thing to really think about, and not to jump around here too much, is that we all know that equity values don't grow at these speeds. You're seeing the liquidity premium grow, and that's where I like to remind people is that trading's very different now. It used to be 5 days before you even knew you owned a stock. You instantaneously own it, and you can turn around and flip it. When the liquidity premium compresses and you throw algorithmic trading on top of it, I mean, we have an algorithm that we run after 350 points down or up, our algorithm just goes crazy. You throw those into, you might see some intense volatility in this election season. So I continue to remind our clients, our friends, and our listeners that, being diversified across multiple asset classes is very important. And why we're touching on volatility, if you don't see the market pull back in the next 2 weeks, you're going to see a lot of short sellers in February get squeezed, and the market is just going to jockey, to heights we've never seen before. So it's interesting times. It's fun time. It's a fun time to be an investor. This is also one of those times where you don't want to make a lot of structural changes to your portfolio.
Yeah. You always talked about kind of Q1 2020 being, last year, kind of this point in time where we could see some good growth into Q1 2020. Beyond that, though, things got a little cloudier. You are seeing a slowdown in earnings growth. I've seen some of it as well in the Security Weekly 25 index that I track. So we're seeing some of that happen. Is that what slows the market down? Or, once we get into summer, now we're into the election season, right? And the election season can always do some interesting things with the market. So what happens beyond Q1, maybe up into like October, a month before the election? Do we go sideways for a while?
Yeah, I mean, I think we're going to see some enhanced volatility. It really goes back to the question your colleague just asked, is that and I kind of noted it on my Boeing point, is that when does the buyer for every seller and vice versa go away? When does the average investor say, hey, this is too expensive. I need to take some profits. I need to sell half my stocks and rotate, back into fixed income. This isn't right for me. I'm taking too much risk. All the talking heads have a date, and I picked Q1 2020 5 years ago. I thought that would be at a point where we all really agree that the expansion is going to slow down with the election cycle. I thought, and this has always been my prediction, whether I'm right or wrong, people would take some chips off the table. It's been a phenomenal run for the last 11, 12 years. And, at a certain point, this absolutely doesn't end. But I think flat, one thing that many of us hadn't and didn't take into consideration 10 years ago when we wrote those investment theses in the 2010 range was none of us had expected there to be basically free money. I mean, if you have a good credit score, you can basically borrow less inflation rate or less the investment risk rate, which is, relatively 2%. You can basically borrow for nothing. I mean, I still can 12 years later call my bank and borrow for 3.25% unsecured, and I can do it in 24 hours. I mean, I'm not specifically this massive powerhouse with this a Boeing-like balance sheet, but money is basically still free. None of us really expected that in the investment world because, let's be honest, the cost of capital 30 years out should be more expensive than the cost of capital now. And that was the big conversation last year, was the inverted yield curve, a yield curve that looks more like a rainbow instead of a doorstop. And these are all things that nobody really expected to do or see, that are still weighing on the market. Fortunately enough, it's very positive. But when that changes, those are some real concerns that we have, because at the end of the day, our clients come to us to protect their principal, and that's the first thing we start with any investment we make.
Got it. So I want to switch gears a little bit because I want to talk about the cybersecurity market, right? A market that this audience listens to. I track the top 25 pure plays in the space. I also I see a lot of startups. We see a lot of funding announcements. What's your take on the market, right? It's an interesting sub-market that sits kind of under the NASDAQ, right? Most of these are tech companies.
Yep.
Thoughts, because you were an early investor in CrowdStrike, I believe. I think you were part of the IPO for CrowdStrike. Right. So just curious, your investment thesis on CrowdStrike and the market as a whole. And then I want to play a couple what-if scenarios with you.
Yeah, sure. So, we are notoriously a real estate, consumer good, energy focused group. I mean, our research is usually around energy. Understandable because the majority of our clients, Denver, Houston, New Orleans, these are folks that work at energy companies. I always, by geographic location, we're an energy shop. But as we grow, as we have much younger clients that are coming on board, that aren't so focused on giving dividends from their portfolio to live on. We've really diversified in some asset classes that historically we hadn't really participated in to add value and alpha to our clients. We at Robertson Wealth Management and in the finance business, we call it fintech. It's becoming a major expense for us. I was thinking about this story just to tell everybody. When I first started in my career, I was a professional trader. I started as an analyst, but I quickly became a professional trader. I used to have to log into my computer, log into my Bloomberg, and I'd need this finger, and I was done. I could trade directly to the ARCA to the floor. Fast forward till now, I need over 12 different passwords and prompts, and I need more than just this finger. I need this finger too to get all the way to the same access that I had back in 2006. So that gives you an idea. And yes, I absolutely write those passwords down on a piece of paper underneath my keypad because there's too many to remember. And the way we protect our client data, it has grown significantly. I mean, for a long time, it was fireproof safes in locked rooms with security cameras. Now we have cloud and that really led us to our thought process in CrowdStrike and the whole sector. The sector is growing. The way we look at it is there's an unlimited need for it. It's fascinating. It's interesting. And from an investment standpoint, what makes it so interesting is the cloud space and the fact that is majority, in our opinion, contracted cash flow. We were early investors in CrowdStrikes. This last batch of IPOs haven't been fantastic. It was kind of a funny group. I think Uber should have IPO'd much earlier than it did. I think that threw a lot of the group off. And a lot of these IPOs, via the structures they came for, were more liquidity events than raises. But we can stay on CrowdStrike. That is now becoming a pretty good investment. I mean, we were pre-IPO, so it's we're up. But we're to answer your question more directly, Matt, we're continuing to add these to portfolios, and we think to be diversified and catch the alpha that you really desire to get to retirement. We'll just frame it there. These have to be part of your portfolio. Where 10 and 15 years ago, we didn't feel that way, and a lot of asset managers, they didn't look there, to get the alpha that their clients desired.
Yeah, one of the challenges, it does. But here's one of the challenges I have with the space. You really don't get a dividend return out of these investments. And we see that in some of the tech companies in general. But if you go through, there's only like 3 or 4 of these companies that pay a dividend, right? So they don't fit into a dividend portfolio. Nope. So does that disincentivize investors like you to invest in the space because you can't get a dividend return on some of these investments?
Well, I that's a really good question. I think the first way to look at that, and it's 100% why Apple pays a dividend, is that certain mandates require dividend. To be in our ultra long dividend growth portfolio or that fund, that goes back to the 70s. I mean, you have to pay a dividend. It has to be trackable, and you have to have the cash to cover it. So yes, it does. It especially for Matt, clients that are coming to us, they've just retired or they're about to retire, and they need money off their account to live, or at least live the retirement that they desire. That's a common ask for us. People come from all over the world for our income portfolio. So yeah, that keeps it out of it. It's one of the things I was mentioning. We're getting a lot of younger people that are coming to us, not people that are just ready to jump into retirement and say, hey, I want to start preparing now. The CrowdStrike, some of the, we had talked about, I know Booz Allen isn't a pure play as you discussed, but that, we have some friends that work there. So we've been using stocks like that, but they're going into portfolios, but you're absolutely right. They're going to be kept out of dividend portfolios. So it would be fortuitous for these companies to slow down their compounding annual growth rate by not reinvesting so much. And at least, even if you pay a 1% dividend, that's enough to get you into mutual funds, ETFs, and wealth manager funds that require a dividend.
Yeah, that's one of the reasons why I don't have a lot of these investments, because I look at the dividend number. I also look at the PE ratios and a bunch of other things.
100%. You go back to 1929, market has returned average to 5 to 7%. I'm rounding those up and down. Almost half of that's dividend.
Interesting. So the other play I want to make off of this quickly is, okay, we get through Q1, we start to go sideways, we get a lot of volatility. If we start to see some contraction in the market, what does that do to the private side of this fence, right? Investments, because we've got a number of startups coming through their pipelines, right? Series A, Series B, some all the way up to Series E. If the markets start to slow down and contract a little bit, does that also put pressure on some of the private funds as well to continue to fuel some of these startups?
I think the real net impact is how the valuation deck will reset. We look at a lot of what ends up being a pre-IPO play. A lot of times, we're looking. We'll run a valuation exercise. They'll have gotten a fairness opinion from an investment bank, and then other family offices that we like to co-invest with. Each one of us have done our homework. We'll kind of share our thoughts and kind of a joint thesis and get there. But yeah, if we see a big contraction in the market, we're going to want to, from our side of the fence, are going to look for that valuation deck to reset down. So we're coming in at a smaller entry point. So yeah, it'll have some difficulty in the market. I mean, tech is still though super strong, and really good portfolio managers will take profits when the time is right. So a lot of money will have been made, and then a lot of money will have to come back out. On the other side of your question, there's still a ton of capital sitting on the sidelines. I ran a large energy group in San Francisco. We were one of the few shops out there, though the base of that company was tech and real estate. But that allowed me and my team access to see what other really good tech investing firms were doing. Investment is a small space. There's just a ton of money on the sidelines, and I think for this space, it's unlimited. It kind of fits in the data center. This stuff people want it, especially behind high quality management teams that can deliver results.
That's good news for the industry. Jason, I've consumed this entire interview. I'm sorry. Any questions for Chase?
Yeah, I did have one question on manufacturing, right? Manufacturing's really been in a lull. What are you forecasting out for manufacturing, and what role does that play in forecasting the future of the economy for at least 2020?
Yeah, so depends on what aspect you're looking at. We are looking at manufacturing to slow just purely on a demand standpoint. We're looking very closely at how commodities, not necessarily oil, impact manufacturing. We've been looking at, if you want to dig in kind of some of the odd places that we specifically look, we'll look at the amount of used cars on the market. We'll look at builders. We'll, like everybody else, we'll look at the widgets. But I think for this next year, manufacturing isn't an issue. I think the real issue globally with manufacturing is that China. We got the results on China's economy last week for 2019. The Chinese economy has slowed to a point, the slowest point it has for the last 30 years. And that's a pure demand standpoint, where I think a lot of investment managers are wrong, and a lot of economists. I'm not an economist. I'm purely an investment guy. Is that people are predicting, India being a huge, Africa being a huge consumer, having spent a lot of time in Lagos, Nigeria, and living in those parts of the world. Yeah, there are a lot of people there, but they can barely afford to eat, more or less consume, those goods and services that people think they're going to eventually buy into. So I think until the wage and wealth gap tightens up a little bit, those consumer channels are off the table. So I think we're really looking to China and America. Though on the flip side, leaving manufacturing to the side for a second and just going into consumers consuming things, times are good right now. So I mean, we are consuming mass amounts of things that we wouldn't necessarily, have purchased, which is good for us here domestically. I hope I answered your question.
Yes. Excellent. Thank you. Yeah.
Yeah.
Are you good, Jason? Because I love having these kind of conversations. It's so much fun. Chase, thank you so much for joining us on Business Security Weekly.
Yeah, thanks for taking the time. Really enjoyed it.
Thank you. We'll take a quick break and then we'll cover the Security Weekly 25 Index updates now.